Welcome to this week's episode of Founders and Funders. This week I have Will and Scott from Driva. Will and Scott, we have been speaking for several years now, but for the listeners who are not familiar with Driva, tell us more about what Driva does and the problem it's trying to solve.
We're fundamentally a consumer finance platform that's set up, and we've really maintained our original mission since day one, which is to enable finance in as few clicks as possible for Australian consumers to start with. And the market we started with, that we saw the largest problem was with auto finance. It's pretty messy market, becoming more complex over time as well, and regulations were a good trigger to drive, I think, the right behaviors and disrupted a lot of the old negative practices that were happening in other dealerships and aspects of where you'd obtain financing, where you really wanted to simplify the whole process and bring it into a really clean and simple and sort of transparent process from beginning to end. And we've stayed pretty true to that. I think since day one, but just expanded into other product categories like personal loans and other geographies now as well.
Yeah, excellent. And my understanding is your background's from McKinsey and Goldman. How did you go from these large firms to wanting to get into car financing?
Scott and I have known each other since university days. We always talked and even fantasized about potentially doing a startup together one day, but figured before we do jump into startup land, we should go and get some so-called grown-up experience. Scott went off to McKinsey, and I started at Goldman Sachs in investment banking. And while the industry exposure we got was super relevant to the problem we were about to try and solve with Driva, it's obviously a huge jump going from corporate world into startup world. I think the best skills it gave me personally, I won't speak on behalf of Scott, but I would guess the answer is somewhat similar, is an ability to know a way around a spreadsheet really well and make a really impressive slide deck. Beyond that, there was a lot of learning as we went, and a lot of the skills on my side for product and growth, and on Scott's side in operations, that we had to pick up along the way, but wouldn't change it for the world.
Yeah, Scott, what about you? What experience from the corporate world did you draw most on when running Driva?
It's very similar to Will. I think like a lot of those core hard skills in Excel and presenting and building pages, as painful as it was for 3 years, and a lot of long hours and things to work on what can be unfulfilling work at times, was definitely paid dividends, I think. And it's still like a skill we use and continue to use now at Driva, and 5 years later. I think the other thing is being potentially like comfortable knowing your way around a problem. And I think especially from a consulting skill set, it's kind of the core of what you do is problem solving in most environments, and being able to break things down and not seeing them as blockers, but something to just solve and work through is something that you're obviously constantly doing as a founder.
Yeah, for sure. So you saw an opportunity in the car financing space. How did you break down into what you were going to launch to market? How did you come up with it? And what was your first iteration of your product?
Yeah, I think the first version that we had in mind was very in line with today's vision, which is a fully automated end-to-end way to very seamlessly find your best car loan offer and get approved in just a couple of clicks in just a couple of minutes. I think the biggest learning when we were starting out is that the first version of your product is never going to be what you think you need to solve the problem. And so the biggest journey we had to go on was figuring out how we could get something into market that would generate revenue that obviously was super clunky and certainly wasn't financed in just a few clicks when we were starting out. In fact, the first version of our product was probably a lot worse than what the traditional brokers had to offer. Yeah, it was about that process of slimming back what we thought we needed to launch and getting realistic about what we could go to market with on day one.
Yeah. And are either of you technical people who coded it, or who did you add to your team, if anyone, to help you build your first version?
Both of us are non-technical. The extent of my technical expertise was less than a year at Uber in their product and ops team, which is not much of a resume when it comes to being a technical co-founder. I think when we were speaking to you, Ray, we were really struggling to find someone at the start of our journey who could help us bring our vision to life. And we didn't know then what we know now about low code or no code tools. So we started with an agency that we managed to build a very cheap version of our original prototype, which I think if we had our time again, we probably would have tried to build ourselves. And then we got very lucky with our first full-time employee, a guy called Victor Schlapkin, who joined us pretty much pre-products, pre-revenue, pre-funding, and has been instrumental in building up the engineering team to where it is today and is still around with us 4.5 years later.
Oh, wow, incredible. How did you fund the first version of your product? Did you do it through friends and family? Did you use your own capital? Did you go to larger firms? How did you fund it?
We were self-funded for our first at least 6 months. That first version of the product, I think, was fully self-funded. It was very low cost in the scheme of things. I can't remember exact dollars, but it wasn't a huge build. And I think the plan we have done reasonably well in our first few years is just keeping things pretty scrappy and light and not over-investing in something which was unproven. So it was a pretty low cost experiment for us. So that took us through into a family office round, which was about 6 to 12 months into our journey. And we were started to already have customers through by the time we had that secured as well, which I think always helps the narrative as well when you're approaching investors at that stage.
Yeah. Did you know these people before in your network, or did you cold call investors? How did you find your investors for your first round?
Yeah, I think that part of the benefit of the backgrounds we came from is there is like a decent Rolodex that you build up and people you can tap into to make introductions to people. So there was the first one less so. It was a smaller list of people that we went to because it's obviously a different group of investors you're going to when you are pre-revenue and you're looking for a smaller check size. But and for subsequent rounds as well, it's been we've all kept a list of investors warm along the way. And I think that's something that we've taken away as well is like try and keep people warm. Don't just go to them when you want to rattle it in and get cash in. It's best to have people that have kind of come along the journey with you. And that really, I think, helped us a lot into the second round, which by that point, there was a few larger VCs and larger family offices that were pretty familiar with who we are and what we were trying to do.
Yeah, nice. And one of the things I hear from startup founders is their go-to-market strategy. And I see, I'm not sure which round you had your partnerships, but I do see you're on carsales.com.au. What was the intention with the funds you were raising in your first round? What were you planning to use those funds for?
Yeah, for us, it was figuring out how to acquire customers and then getting the product closer from where it started to where we wanted to get to with our ultimate vision end state. So obviously we paid Victor's salary out of that first round of funds, and then we started experimenting with different digital channels that we could use to get customers through the funnel and start learning what we needed to build next. And I think, again, the biggest thing we learned was getting a product into market early and getting data through the funnel is absolutely critical, because for us, the priorities slapped us in the face once we were live, and all the things we thought were super important non-negotiables to get a product into market actually weren't. And there was a bunch of other stuff that we ended up building well before we got anywhere near that end state we envisioned. That's where the first pool of funds went.
Yeah, I'm often wrong when running experiments, or my assumptions for the roadmap. Once you start going live and getting customer data, what were some of the surprises that you learned along the way once you started acquiring enough customers from the data, and what changes did you make?
Yeah, one of the biggest things we thought we needed before we went live was API integrations with all the lenders we were working with. Our core goal with the product was to give consumers a really easy way to get accurate rates and eligibility confidence for the product that they were applying for. And when we were starting out, we saw no way of doing that without connectivity into the lenders. What we learned after we launched is that we could actually just get access to those policies in manual ways, like literally PDFs that lenders would send us. And so we learned pretty quickly after launching and signing up a couple of lenders that we're actually better off building those pricing and credit policies into our platform instead of waiting on lenders to build an API that no other brokers in markets were really using. And
Mhm.
at first that seemed like a bad thing because it was going to be a lot more work for us to start with. But now it's a huge blessing because that's really our secret sauce and our defensible moat as it's evolved over the years. And lenders have given us access to more and more information.
Nice. The strategy that you have to acquire customers, tell us a little bit more about the different channels that you acquire customers.
Yeah, for sure. So when you're starting out, it's pretty hard to convince big players like car sales and others that they should partner with us because we don't have a reputation, or to be honest, when you're first starting, you don't have a killer product yet either. So a lot of our early traction was from direct channels, your typical Google, Facebook, but then also some affiliate sites like finder.com, for example. We had a really interesting period because we did our first loan in February 2020, which was, if you recall, when the lockdowns were just being enforced in New South Wales and other parts of Australia as well.
Mhm.
And so there was a really interesting dynamic with advertisers where a lot of the big spenders were pulling budgets completely. And that allowed us to get some really interesting economics like rev share, for example, that allowed us to get a lot more access to traffic than we would have historically. And as I said earlier, that allowed us to really get a good understanding of what we needed to build next and getting some of that data through the pipe to inform our strategy going forward. And then I'd say maybe at the 1.5 year mark, we felt like our product was quickly getting to a really good spot and almost emerging as a leader in the car finance space when it came to customer experience. And so we started having partner conversations about platforms like car sales and a bunch of others leveraging that technology to make that same seamless experience available to their customers in their ecosystem. And so today, a huge chunk of our revenue comes from partnerships. And that's because there's lots of partners, whether it's classified sites like car sales and Trade Me in New Zealand as well, credit score products that want to add value to their users by providing more personalization, or even vehicle manufacturers as well. They're all using our digital capability to offer that same experience to their customers. And for them, whether they're focused on selling cars, whether they're focused on building a credit score product, it makes sense for them to partner with a player like us to uplift their experience instead of trying to add it to the very long list of things that they need to build themselves.
Nice. So for subsequent rounds that you raised, how different was it for in terms of purpose of the funds? Like the first one you mentioned, what about subsequent rounds? How many rounds have you had and what were the different goals?
Yeah, it's been, we've kept our, I guess, cap table pretty tight. We've been lucky to have a good group of investors in our first seed round, which was led by Carolina Capital and a few other individuals and family offices that would form part of it as well. So that they've really maintained since then, and they've supported on some extensions of that round. So we haven't had to get through to a Series A or a Series B just yet. So I think we've reached a reasonable scale with a fairly tight group. And a big part of the reason of that is that it's obviously had some good numbers that have given a good reason to continue investing into us. But equally, I think the relationship that we have with our investors is really strong, and they provide like strategic advice to us and support where we need it without being overly burdensome in the types of requests and things that you hear other founders going through quite different journeys on. In terms of the purpose of the funds, though, it's fairly similar across those rounds. It's always been reinvestment into the product, growing our engineering team to be able to support the automation goals that we have and what we want to achieve with the product as well. So it's I think the type of products that we run is naturally quite like a high for the space that we're in. It's a relatively good margin, and we make good money up front for the loans that we provide, which does mean that we don't have the same cash lag that I think in other businesses would become more of a problem and therefore require like a different capital profile.
What do you see in the market now that you've been live for several years? Do you see other players trying to enter your space, or do you find that your niche is pretty much yours?
Yeah, I think it depends on though we're now sitting across multiple verticals. Like we see our products across car loans, personal loans, novated leases in Australia, and then almost exactly the same in the New Zealand market, which we're operating in now. We've had competitors in basically all of those areas since day one. Like we haven't established a new product, like a brand new product in market where we're playing in an existing product category, but doing it in a way that's different. And we think obviously a better customer experience than everyone else. So we've always had that competitive tension in our space, and especially in the car loan category, there's more of it. There was companies that started at a similar time to us back in 2020, 2021. I think what we've learned is that we stay true to where we think we excel. And I think where that is in these like digital customer journeys and partners that resonate with that digital customer journey. Like car sales is a great example of it. We have competitors that do really well in different types. So for example, like the more traditional car dealerships, that's a very different product offering. And we tried to play in that area at a certain point in time. But I think we've learned over time, like it's a better market for someone else to really come in and excel in that space. It's great to have tension. I have a good relationship with a lot of our competitors as well, but I think we're all ultimately pushing for a similar outcome. And it's a large enough market as well that there can be, we think, 2 or 3 winners in the space.
In my past, there's usually tension between trying to expand in an existing geography versus launching in a new market. What's your view with Driva and its offering in terms of focusing on Australia versus expanding to other geographies?
Yeah, for sure. It's definitely a question that comes up a lot internally, and something we talk to our investors about as well. From pretty early on, we were looking at the New Zealand market as a place that would be relatively easy to expand into, just because the culture is similar. Some of our lenders are in both those markets already. The regulatory environments are quite similar as well. But for us, unless there was a big reason to go over there, the opportunity in Australia was always too strong, such that the opportunity cost of the distraction would be too high. Post car sales, Trade Me, which is the sort of car sales equivalent over there, arguably even more dominant because there's less competition. They knocked on our door and were running a similar process, and we became a pretty natural choice for them. So that was the big pull that got us over into that market. But absent that, it probably wouldn't have made sense. And then there's other, obviously much bigger markets, and we've looked at the US and we've looked at the UK and a bunch of other places. And there's pros and cons for each. I think even if you do find a good looking market that ticks a lot of boxes, there's always a huge opportunity cost and a massive distraction to going and pursuing that market. And I think for us right now, the opportunity right under our noses in both Australia and New Zealand is massive. And the way sort of we think about it at the moment is if there's a clear and somewhat obvious way to 2 to 3x your revenue every year without needing to get distracted and go overseas, then you're better off focusing on the opportunity in front of you. That math changes a little bit if, you're looking at maybe only 20, 30, 40, 50% growth in your local market and you're scratching your head trying to figure out other ways to grow. I think at that point, absent another large partner pulling us into another market, it's only at that point that we'd consider it more seriously, I think.
How were you able to get such recognition in other geographies from your brands? What promotion do you have? How did people hear about you besides the partnerships? How would you accredit your success being top of mind?
Yeah, I think Scott and I don't come from marketing backgrounds, and it's certainly not something that comes naturally to us. We've had a partner-led growth strategy from very early on, and some of the early partnerships we had, business called Cars24 originally, and then Car Sales, really helped raise the profile in what we call like the B2B2C space, where we're partnering with another business to service their customers. So really our profile got raised, I think, through partnerships and the sort of announcements that we did out of that. We have a growth team that spends a lot of their time focusing on direct response type advertising, but we still haven't really ever done any meaningful brand advertising or above the line type activity. So I guess in that sense, a lot of the success we've had is through word of mouth.
Nice. Excellent. You mentioned how Australia still is a very attractive market for you, given the current economic situation with interest rates being higher than a couple of years ago. What do you see in your data on consumer behavior or any potential changes in the future that may impact Driva and the use of car loans?
Yeah, I think it's a pretty interesting one for us, given when we started in 2020, as we kind of touched on, is when COVID was kicking off, and we've only really operated in a pretty unstable economic environment, I'd say, across Australia and especially. And there's been periods where obviously interest rates have been rising, which was a large portion of time. There was a lot of job uncertainty and job seeker, job keeper, all those things that became really difficult from a lending perspective, and no one really knew how to treat it. I think for us, like during that whole period, we were growing because of new partnerships being added on every month. And we never really had a sense of what is normal in the market and how far below or potentially above, but I think more likely below credit demand are we from a normal market, whatever that is. So I think all the data that we look at now is always kind of comparing it to our historicals. But if you look at more market level data, like the Equifax credit demand reports that they release on a frequent basis, there is still like a huge way to go in terms of getting it back to where things used to be. And we're starting to see the signs of interest rates dropping and policies opening up from lenders again. And all of those things are positive signs. I think the value of our product works really well in both markets. In a high interest rate environment, you always want to shop around more, which platform is designed for because there's more variance. Whereas in a low interest rate environment, there's still obviously variance and value to it, but it's a different, I think, mental process that a customer goes through. So we're looking forward to hopefully that credit demand continuing to increase, but in terms of what impact that would actually have, I think it's a bit of an unknown to us.
Yeah, I think we're only really just getting to the point where macro changes would actually have a material impact on our business. My view is, with some rare exceptions, if you're in your first 5 years and you've got product market fit, you should still be able to grow in a bad macro. There's obviously exceptions where if you had just started an event startup at the start of COVID, maybe you'd have to pivot massively and that will create problems. But for us, in our first couple of years, we were so small that adding a new partner in your first year doubles revenue, and there's your 100% growth for the month. And yeah, if you have a product that fits what your partners or your customers really want, then the fact that there's 20% less demand than previous years shouldn't really impact your growth trajectory too much.
Excellent. Yeah, I agree with that. You seem to have timed it very well. And for supporting your growth, you mentioned finding a key tech resource. How have you scaled your org in the recent years to support the growth of the company, and what strategies do you have?
Yeah, it's an interesting one. I mean, I feel lucky. I don't know if Scott feels the same, but I personally feel lucky that I had a great co-founder to start with, because founding solo, I've got huge respect for solo founders because I couldn't really imagine how difficult it would be. As you said, we got lucky with our first head of engineering hire who's grown with the business over the last 4 years. And from there, it's really been about finding people who know a lot more about a particular vertical or area than we do, who is hands-on enough and the type of person that's able to really get their hands dirty for 12 to 18 months, but then has the strategic ability and intellect to step into a more managerial or strategic role when the company's growth permits. For example, our head of products joined around 12, 13 person mark. We didn't have a product team at the time. So he was the product manager and the head of product, and we only had a couple of engineers. And he was a great product manager, great at running tickets, great at testing, everything you'd expect from a good PM. And then when it came to hire our first product manager, they did a great job of finding that product manager and training them, and then moved into a team of 2 product managers, and now is doing a great job at setting product strategy and being more of a product leader. So trying to find those unicorns who can roll their sleeves up to start with and then grow and level up as the company requires is the goal. That's worked really well for us in some hires, but then we really struggle in other areas. We've never had a head of ops for longer than 6 months, right, Scott? And Scott's had to play the role of head of ops for much longer than probably would be desirable. It's a bit of a blessing and a curse that there is 2 of us, because it does allow us to do more, but then maybe sometimes we don't bring in that talent as early as we should, and the company suffers a little bit as a result of that. So it's a never ending challenge, but it's something we spend an increasing amount of our time trying to improve.
Yeah. I noticed from recruitment that people who are great individual contributors often do not enjoy leading teams. So it's hard to find someone who can grow from doing it to then shaping your team and really building it out. And I wanted to ask you specifically on retention that you touched on briefly. That's challenging is, for me, incentive structures are stronger, influence behaviors more than culture. And I also know, having worked in tech, how competitive it is to attract talent. How have you been able to attract and retain talent to Driva?
Yeah, it's something we're super proud of. So a lot of the people, like, to use those examples of the head of product and the head of engineering, I think is the longest they've ever worked at a place. And we're only 4.5 to 5 years old. So these are ambitious people that have really ambitious goals for their own career. And getting them into the organization really depends on selling them on the dream and convincing them that they're getting involved with something that's going to do really great things. You need to set the right incentive structures in terms of pay and equity, which to start with is more geared towards equity. But now that we're in more of a scale-up phase, we're able to pay decent salaries as well. And for those that have been around since the early days, I think they're reaping the rewards of getting in early with a decent chunk of equity, certainly more than you'd be able to get if you join now. And now their pay has caught up to what is market as well. But then the biggest thing I always think that helps retain people is, particularly in those senior roles, is just growth. Like the types of people that we've attracted into the role, they're not going to bail as soon as the going gets tough. But if they think that the product's not going anywhere for an extended period of time, because of the types of people that we've got on the team, they're going to be packing up and going elsewhere. So culture's important, giving them autonomy and ownership's important, having the right incentive structures are also important. But for me personally, I feel the best way to retain some of our top leaders is to just ensure that the business is growing and that they're working on exciting products and the trajectory of the company is on a really good path.
Nice. And there's people listening who are thinking about starting their own company. What lessons have you learned, or what are the things that you wish you knew before starting the company that you can pass on to those earlier in their journey?
I think something we learned extremely early on, and the way Will and I started is we had a list of ideas that we were just working through and testing, and if I try to find one that's stuck, and we were running with two for a while as well, and testing both with customers. And that would have been for a few month period. I think there's a lot of weight that's placed on finding this golden idea that's really going to change the world. And I think reality is that most 99% of it, which is said all the time, is an execution and just being able to quickly adjust and pivot based off feedback you're getting. And I think that's something that held us in good stead, is like we weren't wedded to our ideas up front. We thought like auto finance is obviously a really a strong one, but we got negative feedback from certain people. You want to hear positive feedback, and you won't always get that. You have to find like customers that are resonating with it. I think that's critical, so you can't ignore it if every customer is saying no to you. But if you have a couple of bad conversations with customers or a couple of bad investor meetings on an idea, like that's not the end of it. Like you can work through it, but I'll equally know when to pivot and realize that actually this one's not going to work, change to something else, and then see if that one is sticking better. So I think that's one thing. I think the other thing is, as we've scaled up, and Will touched on this too, is like the transparency and openness across the company has been pretty important to us. Like through difficult times, probably more so than positive times, and difficult times during COVID and everyone working from home, and us being a smaller company at that stage as well. Like we were just super transparent around like what we were working on, partnerships that we were excited by, even like very early stage investments, funding position, like all of those things. I think bringing people along the journey with you and make them feel like part of the ride, because they are ultimately, and you'll get value out of them wanting to contribute and contributing towards the success. And it hurts a little bit more for everyone if they see that like you missed out on a partnership because they were so involved in the process. But it also makes the wins, I think, mean a lot more when they do come through, and hopefully you have more of those than the losses.
Well, I agree with both of those. And you might remember, Ray, that we actually pitched you an identity verification product.
I remember.
When you were working at Afterpay. I completely agree with Scott. I think I used to romanticize the idea that I'd be staring at my window on level 46 at Goldman, and this great grand idea would come to me. And I think that does happen for some people, but certainly for Scott and I, it was much more of a desire to start a business and a desire to work together, and a process of elimination that led us to industry that we do genuinely think needed solving. And we've had personally, Scott had a poor customer experience, and we had a lot of industry knowledge about the vertical as well, but it was more the process of elimination that got us there, as opposed to any light bulb moment. The only other thing I'd add to what Scott said, and I think I touched on it earlier, and it's such conventional wisdom that a little concerned that this will come across as cliche, but getting something into market as early as possible is just the best advice we ever got. Again, we thought we needed the Rolls Royce before anyone would ever use our product, and that's just so not the case. And everything we thought was important didn't end up being important, and we still don't even have today, now that we are much closer to the Rolls Royce solution. And even 5 years ago, I think we ended up paying 20 grand roughly to an agency, which was low cost compared to some other stories we have heard. But even back then, really, Scott and I should have got away with not paying $1 to an agency and building something ourselves, even though we don't have technical backgrounds. And I think that's only even more true today, given how far no code and low code tools have come. And obviously with AI as well, there's really no reason you shouldn't be building that first version yourself, even if you're not technical.
Yeah, for sure. I remember that pitch. And I wanted to ask both of you, you'd probably still be working together, but if it wasn't Driva and it wasn't the identity idea that you pitched to me, what was third on the list as the alternative business idea that you'd be trying? What was the closest next one?
Can you remember, Scott? There was definitely others.
Yeah, I remember there was about 6 that we had. These are the 2 that we got to quite quickly. The other 4 must have been no good. They were all somewhat finance
Okay.
related though. I think that's
Yeah,
the
they're all
background we
fintech.
came from.
Yeah.
It's what we knew.
Okay.
So yeah.
Some banking ideas, like the neobanks were pretty popular then. Yeah, there's some shockers in there, I'm sure.
How about now, thinking if someone bought Driva off of you or you couldn't run Driva anymore, what would you be doing with your time? What business opportunity would you be looking to?
I think for me, there's a few ideas. What's absolutely clear to me is that I'd definitely go again. I feel like it's always challenging, but I know a lot more now than I did when I started. And there's a lot of awesome people that I'd love to work with on a similar problem again. I think the credit bureau industry globally and certainly in Australia is equally broken. And
I agree.
there's sort of only one or two providers
Yes.
that exist. And then there's only really one provider that all the lenders use. And so
Yeah.
they really do have a monopoly, and it wouldn't be a particularly easy challenge to solve, which is why there's still only two players in the market. But I think that would be a huge challenge that if you can crack, there'd be a lot of upside.
I agree. Credit risk was a space that I looked into, trying to branch out beyond just traditional credit scores. And even after all these years, I still feel hasn't been much innovation or evolution in that area. So I agree. So maybe post Driva, give me a call. My final question is, tell us what's next with Driva. What can we look forward to seeing in the market if you can disclose? You're not publicly listed yet.
Yeah, sure. I mean, I feel like we're just, to be honest, just getting started in the space. So we've scratched the surface of what we want to do in Australia and New Zealand for consumer finance. We still think there's like the 10x opportunity in those verticals alone. And we're still would be probably 1% market share, if that, in Australia. So it's just a huge market and a lot more we can do to, we think, solve the problem. So as boring as it may sound, like doing more of the same in the same verticals, but there's tangential products like novated leasing is a great example of something we launched a little while ago, and it's related to car finance. It's just another way of financing your vehicle, but it's quite a different way of approaching it. Super attractive for electric vehicles at the moment. And that was something that kind of came out of nowhere, and we built a whole product around it now as well. So I think short to medium term, it really is like staying core to those products across the now two markets we operate in, continuing to make it a better customer experience, a more automated work towards more fully auto approved customers. So it can be like an instant decision. And then from there, there's other markets that are on our list that we want to get to. But I think it's a prioritization question. It's when the time's right. And when we feel like we're slowing down a little bit in Australia, then maybe it'll make sense.
The only other thing I'd add to that as well is in our first couple of years, it was all about getting as many settlements done as possible and closing those transactions as quickly as possible. Think about a traditional broker post settlement. They're maybe sending their client a bottle of wine, and 3 months later they're calling to check in to see how the new car is going. And then a year later, seeing if they're looking for a second car or a personal loan or thinking about refinancing. And so for us, we haven't been particularly focused on repeat customers, but we know for a typical broker, that's a huge part of their ongoing business. So finding a way to, I guess, digitize that experience and bring it in line with the rest of the product experience that we've built to re-engage and retain some of our existing customers is a super exciting op and will be quite different to what we've done historically.
Excellent. Finally, for listeners who want to try your product, who had a previously poor experience getting car financing, what's the best way to become a customer?
Driva.com.au.
Nice. All right. Thank you, Will and Scott, for your time. I really appreciate it.
Thanks so much, Grace.
Thanks, Ray.